So so we're talking about the gain or loss. So if we have gain or loss on the disposal, so in order to do that, we need to test. We need to test. So now look again, a non-current asset cost 96,000 and was purchased on 1st June year one. Its expected useful life was 5 years, and its expected residual value was 16,000. The asset is depreciated by the straight line method. The asset was sold on 1st September year three for 68,000 naira. They were on disposal cost. It is the company policy to charge depreciation on a monthly basis. The financial year runs from 1st of January to 31st December. What was the gain or loss on the disposal? Now I expect to calculate that, and we know our formula. Our formula says sales proceeds less this disposal cost less carrying amount. That will give us either gain or loss. So the first one, sales proceeds. What is sales proceeds? Sales proceeds is the amount, like I explained, is the amount that you have received from disposal of letting go of your asset, of your asset. So if you look at it, we have the cost of it is 96,000. That's known as the cost on its own. The expected useful life for the 5 years. And it's okay, this is 16 after sales, after use. When you want to make the sales, we have budgeted that it's expected to be 16,000. The asset is depreciated by the straight line method. The asset was sold on 1st October for 68,000. Now, this 68,000 is what is the sales proceeds. The 68,000 is the sales proceeds because that was the amount that was agreed and was paid for. So we have that to be 68. And that one we have is the what? Now we now need the carried amount. And the carrying amount is cost minus accumulated expenditure. Now, what is the cost here? 96,000 naira is the cost here. And what is the accumulated depreciation? The accumulated depreciation it's expected that is where and it's expected okay. Now they didn't give us the accumulated depreciation, so it means that we need to calculate it ourselves. We need to calculate it ourselves, and they are using straight line method. So what is the formula for calculating depreciation? The formula for calculating depreciation is going to be cost minus scrap value divided by estimated useful life. So the cost of this one is 96,000. Number one. Number two, what is the cost of so the cost is 96,000. One, we have that. The another one is 16,000, residual value, 16,000. So 96,000 minus 16,000 based on a formula written above. 96,000 minus 16,000 will give us 80,000. That 80,000 can be used. That 80,000 will now be divided by estimated useful life. What is the total estimated useful life that we have here? 5 years. It's expected to be 5 years. So if we do that for 5 years, it will give you on a yearly basis. Then divide the amount of swear by 12. If you divide it by 12, it will give you on a monthly basis. On a monthly basis. So after you have gotten your monthly basis, you now need to ask yourself how many months in total do the non-current asset actually spend with the company. So if we look at it, and it was purchased on 1st June year one. It was purchased 1st June year one. It's expected useful life 5 years, and expect okay asset the asset is depreciated by the straight line method. Okay, so now they bought the asset on 1st of June year one, and it was sold on when was it sold again? Yeah, it was sold on September. Can you see? September year three. So for year one, we purchased it in June year one. It was sold for September year three. If we count the month in between by saying June year one, June year two, so June year one, July year one, if we count to December, that will give us a total of 7 months. That's 7 months. Then after that, we now look okay, year two is total of what 12 months. So that's 7 months plus 12 months. We give us that's 19 months. After we have gotten 19 months, we now move also to year three. Okay, we are using it up to August. And up to August is how many months? That's 8 months. So 19 months initially plus 8 months will give us 27 months. And that's why we have the 27 months here times what 1,333.33. So if you press what you have in your calculator by not using a one that was has been approximated, you will get 36,000. It means that the total or accumulated depreciation that is related to that asset is 36,000. So now the cost is 96,000 minus 36,000 give us 60,000. Then 60,000 minus 60,000 give us 8,000. This 8,000 is again on loss. I look at the sales for 68. What do we have in our cost before is what is 60,000. It means that we have made gain an extra gain of 8,000 because that value only worth in our record only worth 60,000 naira. But now you are seeing someone that was paying what 68,000 naira. 68,000 naira. So that was good to go. So once again we have the treatment. We have the treatment for we have the treatment for that. So then that's what we did. It's mathematical. It's actually mathematical, but there are some things you can be asked to show it in your team format. You can be asked to show it in T format. So how do you show it in T format? The way you show it in T format by saying when the money, the asset that we are letting go. So we have to credit that account. We have to credit that account and debit the disposal account. The reason why we are crediting the asset account that we're letting go, for example, if it's machinery, the cost on inside that machinery, we have to be taken out. And because an asset have debit entry, it means that amount will be credited to reduce the amount on the debit side. Then also, after that, we move on to the we move on to the bank. Move on to the bank. Now, what is bank talking about? The bank is talking about the money received. Bank is talking about the money received. That okay, how much did we receive? We receive 20,000. Okay, what is the accounting entry for it? The account entry for it is debit your bank account and credit your disposal account, because the reason why you receive the money is because you dispose of the asset. Then after that, we move to the accumulated depreciation. We need to remove the elements of the accumulated depreciation from what? From the account. So we debit accumulated depreciation and credit disposal account and credit disposal account. So I believe that's what we have here. This 96,000 is, can you see? That's all what we have here. So we have the 96,000 naira. We have it here. We took it out from the net assets. We took it out from the assets that we have it here. Then we have the disposal. That's the cost of disposal. This is 8,000. Now based on the sales proceed, then the balancing figure is the gain or loss that we have. That is the balancing figure. Okay. Then after that, we have cost of assets. Can you see we have 96 before? Then it has been taken out to disposal, which is 96,000. Then after that, we have accumulated depreciation account. Now, accumulated depreciation account is that it's always having a credit balance. Okay, credit balance. So we need to remove the related expenditure, the related depreciation that we are charged, that we're letting go. We need to remove it. So we debit that account. So we do other the format using at the first leg, how it affects the second leg, using the first leg, how it affects this other leg. Okay. Now the example 5 is actually straightforward as well. Example 5 says that the company has several motor cars that are accounted for. Okay, as accounted for as non-current asset. Non-current asset. As at 1st January year 2, this cost of the car was 120,000 and the accumulated depreciation was 64,000. During January, the company bought a new car costing 31,000 and was given a part exchange allowance against an old car of 8,000. The car being part exchange equally originally what cost 28,000 and its accumulated depreciation is 18,000 required. Calculate the gain or loss on the asset disposal. Show how the purchase of the new asset car and the disposal of the old car will be recorded in the ledger account. So that's what we are able to. So this majorly is what we call the part payment, part exchange. Part exchange. That, for example, you want to swap your items. You go in with little money, and you take away the new goods, or you go with the old one and you go on with what with the new one. That will call swap. Okay. Yeah, you are done. Okay. He just so what am I explaining right now here is that what there are times that you want to buy a particular item, you go with your old for I normally use phone as an example. You have a phone right now, you are using it, and a new phone just or they just release a new phone and you and desire to get that new phone, you can easily just go out and do a swap. Just take your old phone, go there and add some money on it. So that there are ways in which we account for that as well. There are ways in which we account for that. So the A part is talking about that we calculate the gain and what or the loss on the disposal. So how do we calculate the gain and loss on disposal? We look at our sales proceed for we start our sales proceed. If we look at this place, it was not clearly stated the sales proceed, but it said that and was giving a part exchange allowance of an old car of what 8,000. So the value of the old car that was disposed of for is what is 8,000. That was the value that was what I was disposed. So when they value it, because if you take your phone there, they'll value your phone and they'll ask you to add more money to it before you can go with new phone. So the value placed on that your old phone that you want to let go is what we know as what is what we know as the sales proceed or work value car value can be used as a sales proceed. No, now so after that, so I will now have okay 8,000. So we put 8,000 as our sales proceed. Then afterward we have the carrying amount. The carrying amount is 28,000. Yeah, based on the question, we have 28,000 is there the carrying amount of the old car, 28,000, and we have 18,000. So we have 28,000 and 18,000. So 28 minus 18,000 will give me 10,000. So this is my what? My carrying amount is 10,000. It means that the value that I will put on my asset as at the that moment is 10,000. So how much did I sell it? And that's so I what I let it to revalue for 8,000. It means that I make a loss of 2,000 because something that worth 10,000 they value it at 8,000 and then let it go at 8,000. It means I've lost 2,000 naira difference, 2,000 naira difference. So how do we record this? How do we record this? The way we record this is actually firstly we have the motor vehicle account, we have the motor vehicle account and the accumulated depreciation account. Then from there, we can now start reducing. Okay, so we have this is balance given to us 120, 120, that's the balance given to us 120. Then we have the accumulated depreciation. The accumulated depreciation given to us, we have it to be 640. That is the accumulated depreciation given to us. And after we have done that, the first thing is now to work to recognize it means to take them out to recognize this the asset that actually what does not belong to us again that we have disposed of. So in order for that, so it means that the motor vehicle balance of 120 is being overstated because we have let go some motor vehicle. So we have disposal here, which is 28,000. Disposal 28,000. Then the second leg will be found under disposal account. Can you see? Asset 28,000. That's the second leg. The second leg will be fine under that. Then after that, again, what do we have? We now move to the accumulated depreciation. We have this. So this also 18,000 will be fine on the credit side because we have debited this account. So credit side of it will be under disposal account. So the 18,000. Okay, so let's move on. So after that, again, next thing we need to now look at is the what's it called? Is the bank. Is the bank. How much do we actually pay? How much did the bank pay? The bank they paid us 23,000. How do you get 23,000? The way we got the 20,000 is this. Now the total value, the cost of the new asset is what is 31,000. That's the cost of it. Now and they value this at 8,000. So definitely 31,000 minus 8,000 will give us what 23,000. That will give us 23,000. So we have, can you see? We have motor vehicle, bank. Bank gave out the money because we are one purchasing it. So we gave out the money. So we have to credit that account with 23,000. So we have to go to the asset account. and debit account with that amount as well, 23,000. Now that we have that to 23,000, but remember, the worth of the asset is what? Is the 31,000. 31,000. That's the actual worth of the asset, 31,000. So we now look at, okay, what is our own gain from the disposal of the asset? What is our own gain from disposal of asset? So we now look at that disposal of asset is 8,000 8,000 naira disposal of asset here. Then the second leg will be on the disposal account. On the disposal account, and that will give me where's it? 8,000. Can you see? For the vehicle, 8,000. 8,000. Then after that, you can go ahead and now balance your financial statement. Just go ahead and balance up your financial statement. So you are good to go. Then the standard require you to have a minimum, what's called a minimum disclose requirement. You have to disclose something, so the minimum thing. Okay. Okay, so now what are the things? Number one, the measurement basis. You have to state the measurement. You have to state the measurement basis. Are you using cost basis or evaluation basis? Another one is what we have to calculate. You have to depreciation method used. Are you using straight line method or you are using evaluation method? So you have to state it as well. The depreciation method used. Then another one also we have is also talking about the estimated useful life also must be stated. What is the estimated useful? Is it 5 years? Is it 10 years? Is it 2 years? Then we have the gross carrying amounts and the accumulated depreciation at the beginning and at the end of the year. This is talking about the schedule that at the beginning of the year, the cost should be well stated. Then at the end of the year, the cost also should be well stated, even though there will be difference in the cost. That's what we call movement in financial non-current asset or fixed non-current asset. Fixed non-current assets. So um, okay, so that's that about that. So let's look at the guy. Okay, I think I've explained it. So you can look at this question and try to attempt the question. Try to actually confirm. Please, this topic is very, very, very important and in your own interest. You expect to know it. You expect to know it. So try question one to question one to question to five or so. So try it. If you have any question, please let me know. So I will address to it. So before we move to IS2, any question? Any question? Okay, in absence of any question, let's move to IS2, that's inventory. So let's move to IS2 inventory. So IS2 is all about inventory and it's talking about the how do we allocate inventory? How do we account for inventory? How do we measure inventory? How do we recognize inventory in the financial statements? So they try to address any issue that relate to inventory. So basically, inventory has been defined by the IS2 to mean tangible property held for sales in the ordinary course of business. That's the inventory that you're holding for the meantime to what to dispose it out in way of business. Number two is the process of production, or you have not completed it, you cannot let it go at the moment, so it's still under probability. So it's still under conversion, converting it from one form to another form. Then we now have consumption for consumption in the production of goods and services. So we have the one also that is being produced or being consumed by the manufacturing companies by the production of goods and services. So that is that about that. So we have majorly we have three terms. The term involved we have the three terms of inventory. We have the first one. We have three types of inventory. We have the raw material and component. We have the work in progress, and we have the finished goods. We have three. We have raw material. We have raw material and components. Work in progress and featured and finished goods. Are the three types of raw material that we have. So in case of manufacturing consign, inventory. So majorly, many people don't know about work in progress, except you are working in what in what call it the audit firm or manufacturing company. Before you can decide, to what to use what work in progress. Because what the work in progress means that they are still undergoing some processes yet to be completed. That's work in progress. Then after that, that's when we now have our finished goods. That's when we have our finished goods. So the objective of the IS 16, the objective of IS 16 is actually to determine of income, determination of income. That's number one. So we have objective determination of income. How do you determine the income? Before you can know your income, before you can know the total amount of money that you have paid or you are earned, there is need for you to do what? To charge your inventory against your cost, against your revenue to get cost of sales, to get cost of sales. So a major objective of inventory valuation is the proper determination of income through the process of matching appropriate cost against revenue. Gross profit is found out by deducting cost of goods sold from sales. So when say cost of goods, we deduct, okay? Cost of goods sold is what? Is purchases plug opening stock minus closing stock, hence closing stock. So that was I talking about that determination of income. Before you can determine your gross profit, you need your what? You need your inventory, which is your closing inventory, stock in closing figure. Then also determination of what financial position. Inventory also is found under the current asset. So ability to know what we kept in the store per time is actually what important. So because it's used to value the asset. For example, if the inventory is overestimated, it means that there'll be more profit in the system. There'll be more profit in the system. Okay. Now let's move on. Let's move on. So we have method of reconciling, method of recording inventory. So we have two type of method for recording inventories. We have one, we have the periodic. Number two, we have the perpetual. We have the periodic and the perpetual. So what is periodic? Under this system, the quantity and value of inventory is ascertained by physical coming stock at what physical count of the stock at the end of the year and the accounting date in case of big business houses annual stock a week or a what more than that. Also, what I'm saying here is that for periodic don't actually bother about the movement of store inventory that they have. What is that one thing they want is just keep taking it. At the end of the day, a stock taking will be taken. So once there is difference between that, then you can now go ahead and query that person So that is actually basically what that is meant for. So we have also perpetual. Perpetual method is one that records information as it happens, That is perpetual. So it means every clip and everything is what we will be available. So that's perpetual ability to work to. So it does not. They don't wait, even though they can have stock taking, but they don't wait for stock taking before they can value their closing stock because in and out. So it's actually what is to some reasonable extent. They can go ahead and value your closing inventory, which I believe that some organizations are into that. Some organizations are into that. So let's look at question one. Question one. So there are different ways in which you record it. Under the periodic one, we normally have what called the makeup. So there are two ways. There are ways what we do it. So, for example, under the perpetual, we normally have what we call the purchase account. Under the perpetual, we have purchase. Yeah, we have the purchase account, but under the periodic, we don't have the purchase account because everything is being done at the end of the month. At the end of the month. So let's look question one. Let's see how it's been treated and under each system. Let's see how it's been treated under each system. Number one, we have the what, FCA turning. FCA trading add of 20,000. Purchases during the year we are 60,000. Closing inventory at the end of year two was 24,000. 24,000. At the year end, the following entries are necessary. Show the accounting procedure for the two using the two method. Now you also go, okay, using these two methods, how do we account for it? How do we account for using these two methods? So we have the opening balance to be a 20,000. So we move on. So the first one is periodic. Now what we'll look at now is periodic. Like I said, periodic gives room for what we call the purchase account. Periodic gives rooms for purchase account. Perpetual don't give rooms for purchase account. So under that we have purchase accounts. So when you have trading, opening balance of trading, we have this to be here, 20,000 opening balance. Then after that, what else do we have? Well, purchases. Our purchases during the year, we are 60,000. So we have purchases during the year. Now, once we have the purchases, two things are involved. The purchase account will be debited, the purchase account will be debited, and bank will be credited. And bank will be credited because it's bank that is giving. It's bank that is giving the cash, so bank will be credited. Then after that, what else we have? We have closing inventory at the year end to be worth 24,000. Now that we have our opening inventory, we have our amount bought for the year. Then after that, our closing inventory is 24,000, and we know putting interest balance brought down, we always be on the other side. Balance brought down, will be on the other side. So now that we have, so that's the entry. But remember that our opening balance here, our opening balance or under the inventory will be transferred to cost of sales. Because if you remember the breakdown for cost of sale, we say cost of sale equals what? Opening inventory. Opening inventory. So how do cost of sale opening inventory if it's not transferred to it? So we credit this amount with 20,000 naira as we show as transfer to cost of sales. Transfer to cost of sales. So we have also 24,000 naira from our own side as well. So we look at it, okay. We have, can you see here? We have the opening balance, 20,000. This 20,000 naira came from the inventory account that I show you just now. Then after that, we have, so let's move on. So after we have that, we cannot trace this. This purchase account will be found under our cost of sales. So transfer it to cost of sales. We have to be 60,000. Okay. That's 60,000. Okay. So the next one now is the let me see, let me check. Okay, sorry. Okay, now so we have traced this 60,000 naira now. The next one is okay, if we have 10,000 naira, we have 10,000 naira, that's good to go. The closing balance is 24,000. Then this balance will be different, but this credit side is 44,000, while the debit side is going to be 20,000. So for us to move that, we just call balancing figure, that balancing figure. So what is missing here? 20,000 minus 44,000, it gives us 44,000. It's 24,000. It means that the difference there is 24,000. This 24,000 is what we call the closing. The closing balance that will be taken to the closing balance that will be taken to the profit or loss account. Profit or loss account. So that is majorly the treatment for that. So for perpetual now, perpetual is inventory. Everything that have to do anything that have to relate, anything that relates or information that have to do with inventory is being posted onto one particular ledger, which is the inventory account. Everything is being posted to inventory account. So we have the opening figure. Opening figure is this amount, 20,000. Then after that, we have the bank. So we have bank as well. We have bank of 60,000. Bank of 60,000. Then after that, what else we have? We have the cost of sales. We have the cost of sales. So we have 56,000. How do we get our 56,000? Look at the closing balance. So we 24,000. Our closing balance is 24,000 because it was given to us. So our closing balance is 24,000. Then if the addition of these two and these two, you give us 80,000. So it'll be 80,000 minus 24,000. That'll give us 56,000. So this is the balancing figure. The cost of sales here is balancing figure, is the balancing figure. So that's what you need to do. So another one also you need to look at is the question 2. Oniyale had opening inventory of 100,000. Purchase during the year we have 500,000. Inventory with a cost of 18,000 was returned to a supplier. One of the purchase in the above amount was subject to an express delivery fee, which cost the company an extra 15,000 in addition to the above amount. So now the house ought to prepare this in perpetual format. So basically, it means that every item transfer will be on the what? Any item, any information on the inventory will be on the inventory account. So we have the opening balance to be 100,000. So we are done with this 100,000. We also know reason why it's on debit side because it belongs to class of asset. Then after that, we have purchases during the war. Purchases during the war, we have 50,000 naira. Inventory with a cost of 18,000 naira was returned to a supplier. So 100,000 naira is there. Purchase during the year of 500,000. So they make a purchase of 500,000. So your bank pays while your inventory account receive it. That's 500,000. Inventory with a cost of 18,000 naira was returned to supplier. So that's what? That's cost of what? Two things are involved there. That's return outward. Return outward. So that's what? That's 18,000. Can you find that there? Okay, not there. That's 18,000. Well, that's 18,000. Inventory with the cost of 80,000 was returned to the supplier. One of the punches in the store, one of the purchases in the above amount was subject to express delivery fee, which cost the company an extra 15,000. That delivery fee was called the carriage inward. The carriage inward is relevant, so you put it at 15,000. 15,000. So your bank, your delivery fee, your bank will be credited while inventory account will be debited. Okay, and the purpose is for delivery fee. The another one also we have is the what they have again only at least sold goods. So they sold goods rather. They sold goods of 520, and that is cost of goods sold. That's cost of goods sold. We have cost of goods sold 520. We have that there. Another one that we have is also what goods which at cost 20,000 we are returned to the company. So we are returning to the company. That's on the word inward. Return inward. So you make sales to your clients before now they are returning back to you. That is return inward. So use that to add up because when they return into it, they actually probably it's not that it's bad, it probably because of color and other things. So we post it of inventory account will increase again. Will increase again. Then after just before the year end goes, which had cost 5,000, we are found to have been damaged while being handled by the Onyale staff. So this is what this is normal loss. Normal loss is a loss on us due to improper management by the what by the Onyale store. So we have that to be 5,000. So other one will say we have okay now after that we had up everything together. We had 100,000 plus 500,000 plus 15,000, 20,000. It was 635,000. That's 635,000 is what we expect to have here, but you won't have it here. There's a difference there. So if we add 18,000 plus 520,000 plus 5,000, then basically, then it will now be difference of credit from debit. That will give us 92,000. 92,000. And that is for perpetual. So let's look at method of valuation of inventory. Method of valuation of inventory. So we have two type of method of valuation inventory. We have the cost method and we have the net realizable value. Net realizable value. These are the two methods that we have to value our inventory. We have the cost method and we have the net realizable method. Now, what is cost? What is cost method is used for what? For initial measurement. That the cost of an item is historical cost, the sunk cost is what is used to value the inventory at the point of purchase at the point of purchase. So that's the cost of inventory. So cost of purchase comprised of purchase price, due and taxes, freight inward, and other expenditure directly attributable to execution. So that what said about this is that when you purchase an inventory, the cost of it, the number one, the cost and the relevant costs are added together to be used to value the what to use to value the method. Okay, so we have what we call realizable value. Realizable value simply means the amount the check it. Okay, I think we are not here, so we are not there yet. So let me just explain this cost. Let me just explain the cost. So that's cost. So that cost is used to enter the financial state or to enter inventory into the financial when it's newly purchased. That initial measurement. So basically, question 3 says that Kumar Consumer Electricity as KCE buys goods from an overseas supplier. It had recently taken delivery of 1,000 units of complete X. Okay. Coming. The quoted price of component X was 1,200 per unit, but KCE had negotiated a trade discount of 5%. So there's this discount of 5%. The supplier offered early settlement of 2% for payment within 30 days, and KCE intend to achieve this. Import duties of 60,000 naira per naira. Okay, we are so calculate the cost of inventory. Now they ask us to calculate the cost of inventory. So the idea, the knowledge that we have behind the knowledge that we have behind the IS16 can also be applied here. Now looking at it now, you look at what is the cost. The quoted price is 1,200 per unit. So 1,200 times 1,000 will give us. But they are telling us that there's a discount of 5%. So it means that amount there we have to multiply by 95 to actually get the real value that belongs to us. You have to get the real value that belongs to us, which is times 95%. So so we now have the supplier offer an earlier settlement discount of 2%. Now this 2% is they didn't tell us that they took the advantage of it. They didn't tell us if they're going to take advantage of it. They didn't give us any specification. So we leave that out in our entries. Important import duties. Now, this import duties of 60,000 naira per unit is also part of what is related to it, because if we did actually purchase it, there's no way we incur import duties. We are incurring import duties on the purchase of component X or purchase of component X. So that 60 naira per unit will be an added advantage. The case it may pay a delivery fee of 5,000 to the components to have the components taken to his warehouse. So if we look at the solution, let's look at solution here. 1 million times 5 means that trade discount, import duties as well, delivery cost of 5,000, for the cost of inventories 1,205,000. Then after that, we have what we call the conversion cost. Now, cost, remember when you started this lecture, IS2, we talk about inventory can be divided into 3: raw material, work in progress, and finished goods stock. Now this time around, let's take a look at the movement between the the difference between the what is it called? Trying to remember that. Okay, I can remember that. So we have conversion cost. Cost is okay now. Yes, the difference between the raw material and work in progress is because it has been worked on. The levels of work in progress have been done, or what is called the difference between the cost, and the raw material, the cost of the raw material and the what you call the finished goods. The difference there is the conversion cost. It means that they have worked on the raw material to give us the finished goods. Those conversion costs also must work must be added. They are also relevant in our decision making in order for us to determine or to find out the total cost or to find out the total cost of the inventory that we use to recognize inventory in our financial statement that we use to recognize inventory in our financial statement. So we have so if you look at question 4, we're talking about human consuming KCE manufacture and control unit for air conditioning system. The following information is relevant. Each contain each control unit requires the following. So now they produce what? They produce air condition. Then each of them require one component X and one component Y at the cost of 1,205,800 each. Sundry raw material is at cost of 150,000. The company has the following monthly expenses. So we have the factory rent, we have the energy cost, we have the selling, the distribution. Each unit takes 2 hours to assemble. Production workers are paid 300 naira per hour. So this is the information given to us. So now they ask us to calculate the cost of a single unit. What would be the cost of a single unit? Now for us to calculate the cost of a single unit, all what we need to do is to relate the information. Now from here, I have one component X. So it means that I need component X and component Y in order for me to produce one unit. So I had them all together. Sundry raw materials at the cost of what? 150 at the cost of 150 naira as well. So that also be added to it. So the addition of everything will give us a good sight of what the amount that the after we have gotten that. If you look at the solution, let me show you. Um, okay, can you see the solution? The 1,200 was component X. Then after that, we have 800 for component Y. We have the sundry material. Then we have this figure 2155. Now, this 2155, it means this is the total cost that we have incurred, total cost that are traceable to the sources of the data. So we have that figure. Then we now move on to the second part. The company faces the following. The company faces the monthly expenses. So we have factory rent to be 16,500. So how do we absorb factory rent into our own? We absorb that factory rent by using the information given to us. And information given to us says that the total hour that is expected. Let me show you. Okay. So we have the overhead. Can you see? We have the overhead, and that's 16,500. So 16,500 plus 75 because they are being treated the same way. So we add the two together plus 75. Then after I say divided by 1,000. Can you see that? Divided by 1,000. If we divide it by 1,000, that will give us the factory the overhead cost per hour. Sorry, if you divide it by 1,000, that will give us the overhead per hour. That will give us per hour. So it means that this is the cost per hour. If you run this machine for free factory for 1 hour, this is the cost that we are going to get there. Then after that, we have realized that it's going to take us 2 hours for us to finish one AC. So after we have got the cost per hour, we need to multiply it by 2 so that it can give us the cost per 2 hour, and that will give us 48,000. Then after that, we have the labor cost. We have the labor cost to be 300. How many hours we labor use? 300 hours per 300 naira per hour. So they are going to collect 300 naira per hour. So how many hours are they expected to use to unassemble one? That's 2 days, right? Yeah. So that's okay. Looking at it now, let's look at it together. Each unit takes 2 hours. Okay, that's sorry, 2 hours, not 2 days. 2 hours. Each unit takes 2 hours to assemble it, and they pay them 300 naira per hour. So the total cost for us to labor is 2 hours times 300,000, and that will give us 600,000. So the total amount of this figure will give us the total amount that we're going to use to recognize our cost in our what? That we're going to use to recognize cost in our financial statement. Then we now have the net realizable value. So the net realizable value is actually very straightforward. It means that in price in the ordinary course of business, cost of completion, and less cost necessarily be incurred in order to make the sales. So what net realizable value is talking about the market price less the cost of sales. Market price less the cost of sales in order for us to ascertain if some people have overstated or understated their inventory. There's possible that we have an inventory, old age inventory of 600,000 naira in your world, and that is the huge compared to other things that you have. That is the maximum. The other thing that you have is like 50,000 naira. Then it means that that audit will have to be reviewed. You have to try to what to use net realizable value and not cost model. So net realizable value, like I said, is the market price, like the market price between the two market participants that what after deducting loss or after deducting cost of advertisement. Okay, so after we have that, and the law says that between the cost and net realizable value, you expect to what to use the lower. You expect to use the lower amount. So you expect to use the lower amount between the value. You need to know the lower amount. So looking at question five, we have a business has two items of inventory. A count of the inventory has established that the amount of inventory currently at cost are as follows. So we have the inventory, country, and we have the sales. Our sales minus what selling price. Now sales minus selling price will give us our net realizable value. Net realizable value because we look at our sales. This is our cost price is 10,000. We have 10,000. Our B is 14,000. We have 14,000. Yeah. So the other one is not sales. Now this is cost. Sales. This is selling price. Selling price minus sales price minus selling cost. We give what we call the net realizable value. It means that this is the amount that we can actually get back. This is the amount that we can actually get back from what? From it. Now, this is sales price. This is the market price. Selling cost. If I want to employ someone to sell it on my behalf, I need to pay that for the salary. That is the selling cost. So I will not less my selling cost from my sales price in order for me to get net realizable by my net amount. So from there, I will now compare it from the cost. Now the cost here on inventory A is 10,000. Or the net realizable value is saying 8,000. Definitely, I'm going to recognize that inventory in our financial statement by using what 8,000 naira. By using 8,000 naira. And then the next one we have is what is B. We have 40,000 naira here. Then we have this 15,800, and we said lower. I'm going to go for 14,000 because 14,000 is lower and it conform with the policy. So I'll go with inventory B. I'll go to inventory B on this one. I'll go to inventory B on this one. So that's about. So we also have cost formula. We also have cost formula. Cost formula talks about us value our inventory at a particular point in time. So everybody at a particular point in time, you know our cost of value because we purchase inventories at a different level, at different quantity and different rates. So how do we now add them up together? For example, if I purchase an inventory, let me say a school bag right now, I purchase them for 10,000, and that person goes to bank purchase 20,000, and that goes back for 18,000. So that's a different That's a different amount. So how do we actually know that? Oh, this is the total cost on this bag that I have, even though that was several even though it was purchased at several and different amounts, okay, different boss. So you're still good to go. So we have the method, cost formula method. We have what we call FIFO as first in, first out. We have LIFO. We have as last in, first out. We have FEFO first as first expire, first out. That's what we have. The IS2 emphasize on two method of cost formula, which is FIFO and weighted average and first in first out method. That's what exactly what is emphasized on. So our time has been fast spent. Do you have any question? You have any question? I would like to call it a day. Any question? Okay, no question, right? Okay, so let's call it a night there. So from here we continue next class, okay? So I wish you a lovely evening. Please do enjoy the rest of the day. So see the next class. Bye for now.